The Foundation of Wealth. Author background and key premise. Welcome to this comprehensive exploration of how to think like the wealthy. The Algebra of Wealth. A powerful guide written by one of the most candid, sharp-witted minds in modern thought, Scott Galloway. This is not just a summary, it is a reimagined narration, crafted in a way that lets you sit back, reflect, and allow the truths about wealth, time, and discipline to take root in your soul. In these next 2 hours, you'll hear truths that may challenge your assumptions and possibly alter the trajectory of how you live your life. Wealth is more than money. It is freedom. Freedom from worry. Freedom from dependency. Freedom from wasted time. But achieving it? That takes more than ambition. It takes a formula. Scott Galloway calls that formula the Algebra of Wealth. Chapter 1. Meet the author, the man behind the equation. Before diving into the mechanics of this wealth equation, it's essential to understand the man who wrote it. Early life and struggle. Scott Galloway didn't come from privilege. He wasn't born into a wealthy family, raised in Los Angeles by a single mother who immigrated from the United Kingdom. Galloway witnessed struggle, sacrifice, and resilience at an early age. His mother worked as a secretary, living paycheck to paycheck. Money was always tight, and it showed Galloway firsthand what financial vulnerability felt like. While many kids his age were enjoying family vacations and new clothes, Scott was experiencing a different reality, one that gave him a deep personal understanding of what not having money really means. He describes himself in his youth as awkward, angry, and full of ambition. He didn't get into any Ivy League schools. In fact, he barely made it into UCLA, where he completed his undergraduate degree. He later earned an MBA from UC Berkeley, but not without hard lessons in between. Galloway's early career path was not glamorous. He started at Morgan Stanley as a financial analyst, but soon realized the rigid corporate ladder wasn't for him. From failure to fortune. Like many entrepreneurs, Scott faced multiple failures, but those failures taught him more than any success could. His first major win came when he founded Red Envelope, one of the first e-commerce companies in the 1990s. He also launched L2 Inc., a business intelligence firm that helped brands gain digital clarity. It was eventually acquired by Gartner for over $130 million. He has also been a successful investor, author, podcast host, and professor of marketing at NYU's Stern School of Business. But here's what makes Scott Galloway unique. His voice. He's unfiltered, brutally honest, often politically incorrect, and deeply committed to calling out delusion, whether it's in tech culture, business, or personal finance. Through this raw lens, the Algebra of Wealth was born. Chapter 2. What this book is and isn't, Galloway doesn't offer a get-rich-quick scheme. There are no secrets, no overnight formulas, no promises of Lamborghinis or private islands. Instead, the Algebra of Wealth is built on what Galloway calls the 4 essential variables of wealth: focus, stoicism, time diversification. Each one is simple in theory, but difficult in practice. And like any great algebraic formula, each variable builds upon the next. Mastering just one isn't enough. They work together to create compounding results. This is a book about long-term thinking, realism, and discipline. It teaches you how to build a life of freedom, not through flash, but through rigor. Chapter 3. The Psychology of Wealth. Before we dive into the actual formula, we need to understand the psychology behind wealth. Galloway argues that most people have an unhealthy relationship with money. Either they obsess over it, or they ignore it until it's too late. But for the wealthy, money is a tool. It is not the goal. They use money to buy time, autonomy, and peace of mind. They understand that every dollar saved is more than a number. It's a unit of freedom. Let's take a moment to pause and reflect. What would your life look like if you didn't have to think about money every day? What would you do with your time if you didn't need to trade it for income? These questions form the backbone of the book, and they prepare us to receive the true algebra of wealth. Chapter 4. Variable 1, Focus. The first pillar of Galloway's wealth equation is focus, and it's not the kind of focus you've heard about in productivity books. It's deeper. Defining focus. Focus in this context means economic focus, the ability to dedicate your energy, time, and skill toward a single income-producing path and stay on it long enough for it to bear fruit. The wealthy don't try to do everything. They pick a lane and go deep. Galloway writes, "The most powerful people in the world, those who build real wealth, are monomaniacs. They obsess over one problem, one product, one service, one market. They ignore distractions. They say no far more than they say yes." Example, Warren Buffett. Warren Buffett didn't get rich by being everywhere. He got rich by staying inside what he calls his circle of competence, investing in businesses he understands and holding them long term. Buffett's success is not about genius. It's about focus over time. Your application for the average person, this means choosing one skill set to develop deeply, one career path to commit to for a decade, one financial strategy to stick to. It might be building a marketing agency. It might be becoming a technical expert. It might be investing in real estate. But it must be one thing, at least for a season. The world will pay you incredibly well if you're exceptional at something, but you can't be exceptional at everything. Chapter 5. Focus versus passion. A common myth Galloway destroys is the advice to follow your passion. He says bluntly, "Passion is a luxury. You don't find passion. You earn it." Most people become passionate about things they get good at. You don't start out loving accounting, but if you become great at it and it earns you freedom and respect, passion follows. This mindset is essential for wealth. Chapter 6. Choosing your economic engine. Your economic engine is the skill or career you choose to focus on. Galloway offers 3 rules. Do something that is in demand. Don't chase what's cool, chase what people pay for. Become great at it, not good. Great. Stick with it for a decade. Wealth compounds. But you must give it time. Ask yourself, what skills do I have that are valuable in the market? Where can I earn 100,000 pluses annually by being in the top 10%? Am I willing to say no to everything else for 10 years? Chapter 7. Sacrifice and trade-offs. Focus requires saying no to side hustles that distract you, social media rabbit holes, constantly switching jobs or businesses. The wealthy are often misunderstood early in their journeys because they appear boring. They're not chasing shiny objects. They're building systems. You don't get rich by chasing variety. You get rich by being consistent. Chapter 8. The Fallacy of Hustle Culture. Galloway warns against the modern obsession with hustle culture. Yes, effort matters. But obsession without direction is just noise. The goal is not to work 100 hours a week, it's to work 40 hours with intense focus and strategy. The wealthy value leverage, systems, people, and tools that multiply effort, not just raw hustle. Chapter 9. Focus in Action. Case Study. Entrepreneurs versus Employees. Many people think entrepreneurship is the only way to get wealthy. Galloway disagrees. He argues that many employees build significant wealth, especially those in tech, finance, law, and medicine. The key difference isn't job title. It's focus and discipline over decades. You can build wealth by climbing the ranks in a strong company, earning stock options, investing your income wisely, avoiding lifestyle inflation. Chapter 10. Final Thoughts on Focus. Focus is the engine of wealth. Without it, you will spread your time and energy too thin to make an impact. Your next step is to identify your one thing and begin the decade-long journey to mastery. As Galloway says, the person who chases 2 rabbits catches none. Part 2. Mastering Emotion, Stoicism, and the Wealth Mindset. Welcome back to our journey through the Algebra of Wealth. In Part 1, we explored focus, the first and perhaps most misunderstood variable of the wealth formula. Focus brings clarity, commitment, and compounding strength. But it's only one part of the equation. In this chapter, we move into stoicism, the ability to regulate emotion, act with logic, and maintain discipline in the face of chaos. Chapter 11. What is Stoicism in the context of wealth? Stoicism is often misinterpreted as cold detachment or indifference, but Scott Galloway reframes it as emotional control, particularly in financial decisions. In simple terms, Stoicism is the ability to ignore noise and resist emotional reactions when stakes are high. Wealthy individuals are masters of emotional discipline. They know when to act and, more importantly, when not to. They don't buy because the market is up. They don't sell out of panic. They don't let envy dictate their choices. They operate from logic, not fear. This mindset is what separates those who stay wealthy from those who simply get wealthy. Chapter 12. Emotional reactions are expensive. Let's break this down. Every time you let your emotions control a financial decision, you're essentially paying a premium, an invisible tax on your impatience, fear, or greed. Galloway points to data from the stock market. The average investor underperforms the market not because of bad choices, but because of bad timing. People sell during downturns. They buy when assets are overvalued. They move in and out of strategies, chasing returns. This behavior destroys wealth. Wealthy people resist this urge. They have a plan, and they stick to it, even when it hurts. Chapter 13. Fear and Greed, the twin enemies of wealth. These are the 2 emotions that sabotage financial success. Greed, chasing the next big thing. Risking everything to gain more. Believing you can outsmart the market. Over-leveraging in real estate or crypto. Fear, selling investments during a downturn. Refusing to invest because the economy might crash. Never taking calculated risks. Staying in a job or relationship out of anxiety. Galloway teaches that wealthy thinkers understand the cyclical nature of markets. Ups and downs are part of the game. The trick is not to react emotionally. Your ability to stay calm in volatile times is directly proportional to your ability to grow wealth. Chapter 14. The Long Game, Controlling Impulses. Stoicism enables the most powerful habit in personal finance, delayed gratification. This means driving the Honda instead of the BMW in your 30s so you can own time in your 50s. Skipping the luxury vacation to fund your investment account. Investing in your career, health, or education instead of chasing comfort. Wealthy people sacrifice now for later. The world trains you to want things immediately. Fast money, fast fame, fast pleasure. Stoicism asks, what if you waited? The ability to delay gratification is one of the strongest predictors of long-term success. Chapter 15. Mental resilience in financial chaos. Think about the 2008 crash or the 2020 pandemic market plunge. The people who sold in panic locked in losses. The people who stayed in recovered, and then some. Galloway shares a fundamental truth. Markets recover faster than people do. The lesson? Don't act on headlines. Don't let Twitter dictate your portfolio. Don't follow the crowd unless you want average outcomes. Practice emotional distance. Create rules for when you'll buy and sell, then stick to them. Chapter 16. Stoicism in Lifestyle. It's not just about investing, it's about how you live. Lifestyle stoicism means living beneath your means even when your income rises. Avoiding status games, cars, clothes, watches. Knowing that buying happiness doesn't work if you're unhappy inside. Wealthy people often don't look rich, at least not while they're building. Galloway challenges readers, if you want to be rich, stop trying to look rich. The need to signal wealth is often a sign you don't have it. Chapter 17. The Stoic Wealth Code. A summary. Let's crystallize this into principles. Plan your money with logic. Remove emotion from the equation. Expect volatility. Don't be surprised by downturns. Use them. Automate investments. Remove the chance of emotional disruption. Delay big purchases. Give yourself time to decide. Practice gratitude. Recognize what you already have. These practices build not just financial wealth, but emotional wealth, peace of mind, resilience, and control. Chapter 18. The power of boring. Galloway loves this phrase. Boring is beautiful. The most successful wealth strategies are repetitive, conservative, long-term, unemotional. The wealthiest people he knows aren't thrill seekers. They're steady builders. They max out their 401ks, buy index funds, own their home, invest automatically, say no more than they say yes. Excitement is for entertainment. Wealth is for boring, steady, strategic discipline. Chapter 19. A Stoic approach to risk is inevitable, but Galloway stresses that calculated risk is different from reckless gambling. The wealthy think in asymmetrical risk. What's the downside? What's the upside? Can I survive if I'm wrong? They protect their downside first. For example, they insure their assets. They keep emergency funds. They diversify holdings. They don't go all in on one investment. Chapter 20. Building emotional discipline. Over time. This doesn't happen overnight. Galloway encourages people to build emotional discipline the way you build muscle, one repetition at a time. Start with small exercises. Don't check your portfolio for 30 days. Wait 24 hours before any major purchase. Challenge every impulse to upgrade or flex. Meditate to observe your financial anxiety without reacting. Over time, you'll begin to think like the wealthy, calmly, strategically, unshaken. Chapter 21. Emotional detachment from status. Galloway goes deep on this. One of the greatest signs of emotional maturity is not needing to be seen as successful. Social media rewards flash. The wealthy ignore it. They understand that real wealth doesn't need to be posted, liked, or bragged about. Real wealth is private, quiet, unapologetically unflashy. If you can detach from needing to impress others, you unlock the kind of stoicism that fuels generational wealth. Chapter 22, Case Study, Stoicism in Action. Let's walk through a fictional example. Meet Jordan, age 30 income, $75,000, goal, financial independence by 50. Without stoicism, buys a $50,000 car with debt, jumps into crypto based on hype, spends $800 a month on luxury items, changes jobs every year out of frustration. With stoicism, drives a used car and invests the difference, invests in a broad index fund monthly, builds a 6-month emergency fund, focuses on career skill growth, not job hopping, fast forward 20 years. Jordan with stoicism has 1.5 invested. Jordan without it is in debt. This is the power of consistent, emotionally intelligent action over decades. Chapter 23, Final Reflections on Stoicism. Wealth doesn't come from knowing everything. It comes from doing fewer things better, with consistency, control, and emotional discipline. Galloway writes, "The market punishes emotion and rewards discipline." The next variable of wealth, time, is what turns this stoicism into a rocket. But before we go there, pause and ask, where in my life am I letting emotions control my money? What would it look like to be calm, consistent, and clear for the next 10 years? You don't need to be a genius. You need to be stoic. Part 3. Time, the hidden multiplier of wealth. We now arrive at what is perhaps the most important and most misunderstood ingredient in Scott Galloway's wealth equation, time. We've already explored focus, the ability to commit with precision and intensity, and stoicism, the emotional strength to make rational decisions in the face of uncertainty. But even if you master both, without time, your wealth will never compound. Because time is what allows everything else to multiply. Time isn't just a background variable, it's the engine of compounding, and the earlier you start using it, the more powerful it becomes. Let's dig in. Chapter 24. Time as currency. What if I told you that time, not money, is the true currency of the wealthy? Galloway explains that money is just a proxy for time. Think about it. You trade time for money at work. You trade money for convenience and time when you outsource. The goal of building wealth isn't to have more money. It's to have more freedom with your time. This is a mindset shift. The rich don't work for money. They use money to stop working. Every dollar saved and invested buys back future minutes, hours, days. Time is what makes money meaningful. Chapter 25, The Magic of Compounding. Let's talk compounding. Albert Einstein allegedly called compound interest the 8th wonder of the world. Whether he did or not, Galloway agrees with the sentiment. Compound interest is when your money earns interest, and then that interest earns interest, and so on. Over decades, this becomes exponential. But here's the catch. It only works if you give it time. Let's do a simple thought experiment. Example, if you invest $10,000 at an 8% annual return, in 10 years, $21,589 in 20 years, $46,610 in 30 years, $106,26 in 40 years, $217,245, the biggest gains come in the last 10 years, not because you worked harder, but because you waited longer. Time is not a passive force. It's an accelerator. Chapter 26. Start early, no matter what. One of Galloway's core messages is, start investing as early as possible. Not because you'll be rich overnight, but because time is the most irreplaceable resource. Even small contributions make a big difference if they have enough time to grow. Let's compare two people. Sarah starts investing at 25, contributes $300 a month for 10 years, then stops and lets it grow untouched. Mark starts at 35, contributes $300 a month for 30 years. By age 65, Sarah ends up with more money than Mark, even though she invested far less. Why? Time. The earlier you start, the less you have to invest. The key isn't being rich, it's being early. Chapter 27. Why people wait too long. So why don't most people start early? Galloway outlines several reasons. They don't understand compounding. They think they need a lot of money to begin. They procrastinate because retirement feels far away. They prioritize short-term consumption. But every year you delay, you lose one of the most powerful assets in the wealth-building toolkit: time. You can't borrow it. You can't manufacture it. Once it's gone, it's gone. Chapter 28. Time-based investing strategy. Here's the strategy Galloway recommends. Automate your investments monthly. Don't think about it. Use index funds or ETFs for simplicity and long-term growth. Avoid trying to time the market. Start as early as possible. Even with small amounts, don't touch it, let it grow. He recommends investing in something like the S&P 500 through a low-fee fund. Don't chase trends, chase consistency. Chapter 29. Retirement is a lie without time. Galloway dismantles the traditional view of retirement. Retirement isn't about stopping work, it's about owning your time. The goal isn't to do nothing, it's to do only the things you want. Retirement shouldn't be a sudden stop at 65. It should be gradual control over your schedule, your projects, and your commitments. To do that, you must use time early, while your energy, creativity, and flexibility are high. Chapter 30. Time is not equal for everyone. Let's face reality. Time doesn't operate the same way for everyone. Galloway acknowledges the truth. A person who grows up with wealth has a head start. Access to good education, healthy environments, and safety accelerates compounding. Economic privilege buys time. But the principle still holds. Wherever you are, use the time you do have. Start where you are. Start now, even if it's small, even if it's late. The biggest mistake is waiting for the perfect moment. Chapter 31. Daily time management. A hidden lever. Time wealth isn't just about decades. It's about how you use your hours. Wealthy thinkers use time with intention. They say no to unproductive meetings, limit mindless screen time, batch work for deep focus, prioritize sleep and fitness. Galloway has a rule: if you don't control your calendar, someone else will. He suggests asking yourself daily, is this the best use of my time today, or am I just reacting? Chapter 32. The opportunity cost of time. Every yes is a no to something else. The wealthy internalize this. Saying yes to overtime means saying no to your child's soccer game. Saying yes to scrolling Instagram is saying no to building your side business. Saying yes to comfort is saying no to growth. Galloway encourages us to calculate the opportunity cost of every decision, not just in dollars, but in time and freedom. Chapter 33. Use time to build assets. The best use of time? Build assets. Assets are things that make money without your presence. These include investment accounts, real estate, intellectual property, books, content, courses, equity in a company. Digital products. Every hour you spend building an asset is an hour that pays you back forever. That's how the wealthy use time. They invest it into assets that keep working when they stop. Chapter 34. Debt. The time killer. Galloway is brutal about this. Debt steals your future. Consumer debt, especially high-interest debt like credit cards, is the enemy of compounding. Here's why. It works against you every day. It compounds in reverse. It turns your time into repayment. It limits your options. He recommends aggressively paying off all consumer debt before investing heavily. Don't try to build wealth while dragging a ball and chain. Chapter 35. Time with family and friends. Not all time is about money. In fact, the most valuable time is often unpaid. Time with your kids while they're young, time with aging parents, time building memories and relationships. Wealth is about having the freedom to be there, to attend, to participate, to celebrate, to rest. True wealth is being able to say no to anything that steals your presence. Galloway shares personal regrets about missing early moments as a father because of work. That pain shaped how he now defines time wealth. Chapter 36. Age and Time. Perspective. Different decades offer different forms of time leverage. In your 20s, time is your strongest asset. Don't waste it chasing lifestyle status. Invest early. In your 30s, use time to double down on skills and compound relationships. In your 40s, let time do its work. Stay the course. Teach others. In your 50s plus, use time to live your values. Focus on legacy. Each stage matters. Each hour matters. Chapter 37. Buying back your time. As your income increases, start buying back your time strategically. Hire cleaners. Pay for meal delivery. Outsource low-leverage tasks. Hire help to scale your work. You can always make more money, but you'll never make more time. The wealthy trade money for time. The poor trade time for money. This doesn't mean being lazy. It means being leveraged. Chapter 38. Case Study. Time as a wealth lever. Meet Dana. Age 28, earns $60,000 a year, lives modestly, invests $400 a month, automates her investing in index funds. Dana doesn't try to flip stocks. She ignores crypto hype. She just lets it grow. By age 58, she has $900,000 plus. Meanwhile, her friend Mike starts at 40 with $800 a month. By age 58, he has $420,000. Same total invested. Different outcome. Why? Time. Chapter 39. Galloway's closing thoughts on time. In his final remarks on this variable, Scott Galloway reminds us, time is your most precious asset. Everything else, status, income, power, can be regained. Time cannot. He urges everyone to guard it, invest it, use it to build things that matter, because when time is gone, no amount of money can bring it back. The Algebra of Wealth. Full summary by Scott Galloway. Part 4. Chapter 7. Grit. The unsexy foundation of wealth. Scott Galloway often reiterates, success isn't C, it's repetitive, unglamorous, and deeply rooted in grit. This chapter unpacks grit as a cornerstone of wealth, demystifying it and grounding it in practical, achievable behaviors. What is grit? Grit is not about heroic stamina or endless hustle. It's about consistency, commitment, and staying the course, especially when you're bored, unmotivated, or scared. Galloway emphasizes that grit is less about intensity and more about consistency over time. It's showing up on time, every day. It's saying no to distractions. It's sticking to the same savings plan for 20 years. It's not quitting your job because it's boring. It's mastering it before moving on. He calls grit the compound interest of effort. Just as money compounds, so does consistency in effort. Every boring, repetitive task builds toward mastery and financial security. The grit equation grit, talent, X effort Galloway quotes Angela Duckworth's work on grit and expands on it with his real-world view. People with average talent but extreme consistency outperform the brilliant but lazy. Your outcomes in wealth often have little to do with IQ and more to do with stick-to-itiveness. He also shares a personal anecdote. At NYU, he wasn't the smartest professor, but he responded to every student's email, read every paper carefully, and showed up prepared day in and day out. That commitment raised his reputation, income, and platform. How to cultivate grit. Commit to long-term games. Pick industries, relationships, and business models where you can play for decades. Surround yourself with gritty people. Grit is contagious. Find people who push through tough seasons. Make grit a system, not a trait. Build habits and automation that make showing up easy, e.g. automatic savings, recurring workouts, meal prep. Reframe boredom. Wealth comes from doing boring things well. Saving, investing, reading quarterly reports. Grit is not glorious, but it's profitable. Chapter 8. Optionality, the wealth multiplier. The next building block in the Algebra of Wealth is optionality, one of Galloway's favorite ideas. Optionality means having the ability to choose, to walk away from bad jobs, to pivot careers, to start a business, or to take time off. The wealthy have options. The average person often lives paycheck to paycheck, bound by obligations. The wealthy by freedom of choice. Optionality is freedom's cousin. Examples. A wealthy person doesn't need to attend every meeting. They don't need to say yes to every project or client. They can take sabbaticals, shift industries, or invest in startups because they have runway and leverage. Galloway notes, optionality is the lubricant of happiness. How to build optionality. Cash reserves. Money in the bank gives you breathing room. Galloway recommends saving at least 12 months of living expenses. Marketable skills. Coding, marketing, public speaking, finance. Skills that compound and can be monetized across industries. Low fixed costs. Avoid locking yourself into high monthly expenses. High costs reduce your optionality. Strong network. People with optionality have other people who open doors. Build relationships with people in various sectors. Equity ownership. Whether in your business or through investments, ownership offers exponential returns and more options. Optionality means you can say yes when it's strategic and no when it matters. Chapter 9. Resilience, the wealthy bounce back. Faster. Another hallmark of the wealthy, they recover quickly. Life throws punches at everyone, but resilience, not perfection, defines success. What resilience looks like? Losing your job and bouncing back with a freelance hustle. Taking a financial hit and cutting expenses instead of panicking. Dealing with rejection without losing momentum. Staying in the market during a crash. Galloway reminds us that wealthy people fail often, but they never stop moving. They understand that long-term wealth isn't linear. It zigs and zags, but their identity isn't shattered by setbacks. Resilience is a skill. Mental reframing. Instead of asking, why me? Ask, what now? Financial buffering. An emergency fund absorbs shocks. Emotional detachment. Separate your self-worth from financial ups and downs. Purpose-driven hustle. If your work ties into a deeper mission, you're more likely to recover and recommit. Scott shares that he was fired from multiple jobs in his 20s, but because he saw each loss as feedback, not failure, he grew stronger. Chapter 10. Ownership, how the wealthy escape the time trap. One of Galloway's clearest teachings, you won't get rich renting out your time. If you trade hours for dollars, especially at a flat rate, you cap your upside. Wealthy people own things that generate money while they sleep. The formula: wealth, assets, not labor. Galloway urges readers to shift their mindset from worker to owner. Own equity in startups. Buy stock in public companies. Invest in real estate. Build intellectual property. Books, online courses, YouTube channels. These assets generate passive or semi-passive income. He calls this escape velocity. Your income accelerates faster than your effort because your assets compound even when you're on vacation. Examples of ownership-minded thinking. Don't just work for Uber. Try to own a part of Uber or the next Uber. Don't just be a top seller. Ask for equity in the company you're growing. Don't just freelance. Build an agency that hires others. Don't just write. License your content or self-publish. Employee versus owner mindset. Employee mindset, owner. Mindset thinks in hours, thinks in equity, optimizes salary, optimizes value creation, fears risk, uses risk strategically. Chapter 11, The Algorithm of the Wealthy. Galloway distills wealth building into a replicable pattern. Develop a valuable skill. Work insanely hard for 5 to 10 years. Live below your means. Buy appreciating assets. Avoid debt. Build optionality. Own equity. Let time do its work. He calls this the algorithm of the wealthy. Not C, but incredibly effective. It doesn't require genius. It requires patience, systems, and self-discipline. Chapter 12. The Wealthy Mindset. Finally, Galloway reflects on the mindset shifts required to think like the wealthy: long-term over short-term, ownership over wages, value over status, discipline over impulse, leverage over labor. He closes this portion of the book by reminding readers, money doesn't make you happy, but it lets you control your time, who you spend it with, and what you do with your life. That's real wealth. Part 5. Discipline, Consistency, and Focus. The Wealth Multipliers. The Myth of Overnight Success. Scott Galloway doesn't believe in fairy tales, and especially not in the seductive illusion of overnight success. What the media glamorizes as an overnight breakthrough is often the result of decades of compounding effort, setbacks, persistence, and patience. People don't get rich overnight. They get rich slowly, then all at once. The core message: wealth is a result of long-term discipline. Wealthy individuals delay gratification, reinvent themselves, and persist long past the point where others give up. Discipline. The daily edge. One key trait that separates the wealthy from everyone else is discipline. Not talent, not luck, not connections. Discipline is the quiet engine of wealth. Galloway emphasizes that you must do the things you don't want to do every day without needing motivation. That's discipline, doing the work even when the excitement has worn off. Examples of wealth. Discipline: saving a fixed percentage of your income every month. Saying no to lifestyle inflation, living below your means for years while investing the difference. Choosing to work weekends while others relax. Those with wealth discipline build an empire slowly but surely. Consistency, the real compounding factor. Consistency is what amplifies the results of discipline over time. It's not about doing a massive amount of work in 1 week. It's about doing a little every day for 10+ years. This is the same principle as compound interest. The longer you stay in the game, the greater the rewards. Get rich slowly, consistently, and predictably. Most people overestimate what they can do in a year. and underestimate what they can achieve in a decade. Galloway's wealthy friends aren't always geniuses, but they are unreasonably consistent in their habits. Focus, eliminating noise. Focus is the next wealth multiplier. Galloway frames focus as the ability to say no. Wealthy people have an uncanny ability to ignore distractions, tune out noise, and zero in on what matters. Distractions destroy compounding. That's why the wealthy focus on one industry and master it. Work relentlessly on a few high ROI projects. Avoid shiny object syndrome. Invest only in what they understand. Focus helps you escape mediocrity and ascend to excellence in a narrow domain. That narrow domain over time becomes your moat, your unfair advantage. The secret weapon, repetition. If you want to rewire your brain for wealth, repetition is your ally. The most successful people repeat the basics for years. They reread the same wealth-building books. They reinvest profits again and again. They restate their goals every day. They repeat simple money behaviors for decades. Galloway emphasizes, wealth is boring. It's made up of a few things done over and over and over. You compound behavior, not brilliance. Part 6, the wealth formula. Earning, saving, investing, and time. At this stage in the book, Galloway introduces a simplified algebraic formula for wealth. Wealth, earning, spending, X investing, X time. Let's unpack it. Earning, build an income engine. Step 1 is to earn as much as you can within your zone of competence. Galloway doesn't advocate chasing passion as a primary strategy. Instead, he suggests chasing proficiency. Get great at something the market values. High earnings are often the result of technical skill, strong communication ability, relentless networking, leverage of scale, products, content, capital. Whether you're a doctor, coder, or entrepreneur, top-tier income gives you the raw fuel for wealth. Spending. Live below your means. This is the multiplier most people ignore. Galloway stresses that you cannot out-earn reckless spending. Wealthy people aren't always frugal, but they start frugal. They delay luxury until their money is working harder than they are. Many millionaires drive old cars, wear inexpensive watches, and live in modest homes for years before upgrading. The golden rule: spend last, invest first. Investing, own assets, not just labor. You don't get wealthy trading time for money. You get wealthy by owning things: stocks, index funds, real estate businesses, intellectual property, books, courses, content. Galloway urges readers to move from labor income to asset income. Over time, assets work while you sleep. That's the real path to financial freedom. He favors long-term index investing for most people. Low cost, low risk, and highly effective over decades. Time, the ultimate amplifier. The final variable in the equation is time, and it's the most powerful. The earlier you start investing, the more exponential your results. Wealth or behavior, X time. This means starting to invest at 20 instead of 30 can mean millions more at retirement. Consistent behavior for 30 years is far superior to aggressive behavior for 5. Time multiplies mistakes and smart moves. Time is the only true magic in personal finance. Galloway's advice: automate wealth behavior early, then let time do the rest. Part 7. The mindset of wealth. Reframing your identity. To conclude the core of the book, Galloway dives deep into the psychological foundations of wealth. He argues that true wealth building starts in the mind, not in your bank account. Your self-identity drives your behavior. If you see yourself as bad with money, just a regular person, not good at investing. Then those beliefs become self-fulfilling prophecies. Galloway pushes readers to adopt the identity of a wealthy person long before they're wealthy. Act like an investor before you have investments. Think like a millionaire before you have millions. That means you study money, you talk about building wealth, you hang around others with money mindsets, you reject broke thinking, you rewire your identity to match your desired future. Emotional control is wealth control. Another powerful psychological point. Emotions are the enemy of wealth. Fear makes you sell during market crashes. Greed makes you buy things you can't afford. Envy makes you chase status over substance. Impatience makes you ruin compounding. The wealthy learn to detach emotionally from the ups and downs of markets and income. They think in decades, not days. Comparison is the thief of wealth. In the age of Instagram and TikTok, Galloway warns of a hidden killer, comparison. The algorithm wants you broke and jealous. Wealthy people train their minds to focus inward, on their own goals, on their own financial lane, on their values, not others' validation. If you spend your life trying to look rich, you'll never be rich. The truly wealthy often look average because they're too busy becoming rich to prove it. Coming up next, in the final part, we'll cover wealth traps to avoid, how to leave a legacy, the emotional side of money, Galloway's personal failures and lessons, a practical 10-step roadmap to think like the wealthy. Part 7, Practical Pathways to Wealth, Systems, Discipline, and Compounding Discipline, the keystone of financial mastery. Scott Galloway continually returns to the role of discipline, financial, emotional, and personal, as the unshakable bedrock of wealth accumulation. He argues that while talent and timing help, discipline sustains. Delayed gratification. Galloway praises the ability to forego momentary pleasures in favor of long-term gain. It's the single trait most predictive of financial success. For instance, rather than buying a $70,000 car with a $1,200 monthly payment, he recommends saving and investing that amount, potentially yielding millions in compounded returns over time. Automated systems. The wealthy don't leave discipline up to mood or willpower. They build systems. Auto debits for investments, fixed monthly budgets, alerts for overspending, pre-committed long-term savings, 401k, IRAs, real estate. You don't rise to the level of your goals, you fall to the level of your systems. James Clear, a quote Galloway often echoes in spirit. Understanding risk. Like the wealthy individuals and investors don't avoid risk, they manage it wisely. Galloway explains how risk tolerance is developed over time, not something people are just born with. Calculated risk. Wealthy thinkers don't chase get-rich-quick schemes. Instead, they focus on asset diversification, income stability, high probability, long horizon bets, constant skill reinvestment, asymmetric risk-reward. Galloway highlights how wealthy people aim for bets where the upside is enormous and the downside is capped. Examples include early-stage investments, joining startups with equity potential, real estate bought in emerging markets, skill-building projects, e.g. launching a YouTube channel, coding boot camp. The compounding mindset. Nothing accelerates wealth more predictably than the quiet force of compound growth. Galloway drives this point relentlessly. Wealth is boring. Compounding looks unimpressive at first. It's the daily discipline of small wins. Investing 500 months starting at 25 can yield over $1 million by retirement. Reading 20 pages a day turns into 24 books a year. Exercising 30 minutes daily adds 10 plus healthy years to life expectancy. Start early. Stay in. The earlier you start investing in yourself, your career, your finances, the more the curve of compounding works in your favor. The wealthy treat compounding like a divine law, not an optional tactic. Part 8. The wealthy understand leverage. Types of leverage. Scott Galloway defines leverage as any force that multiplies your output without a proportional increase in effort. The wealthy don't just work hard, they work smart by leveraging tools and networks. Capital leverage, using money to make more money. Investments that generate cash flow, hiring others to multiply time. Labor, leverage, building teams and systems, delegating to scale efforts, creating businesses that function without direct input. Media leverage, writing a book once that earns for decades, starting a podcast or blog, building a YouTube channel or Instagram brand. Code leverage, writing software or automating systems, creating products that scale infinitely with low marginal cost. Modern leverage, Shark infinite scale. The key to 21st century wealth? Create something once, then scale it globally through the internet. An online course, a viral app, a digital product, a scalable service, consulting agency, SaaS, coaching business. Wealthy people don't trade time for money. They trade ideas, systems, and automation for money. Part 9. Assets over status. Why assets win over image. Many middle-class people confuse status signals with wealth. Galloway offers sobering advice. A $70,000 car doesn't make you rich. Owning the dealership that sells 100 cars a month does. Wealthy individuals prioritize assets that appreciate, real estate, stocks, businesses, income-generating machines, online brands, investments, licensing deals, networks, strategic relationships with other doers, builders, investors, fake rich versus real wealth, fake rich, designer brands, fancy cars with loans, no emergency fund, working paycheck to uphold a facade, real wealth, assets that grow, multiple streams of income, living below means, no need to impress anyone. The wealthy don't care what you think about their shoes. They care what their balance sheet thinks. Part 10. Mastering the 4 variables of wealth. As outlined earlier, Galloway's Algebra of Wealth rests on 4 key variables: focus, stoicism, time, and diversification. Here's how he expands each into daily practice. 1. Focus. Multiply what works. Deep work, multitasking. 1 project executed well beats 10 half-finished ones. Cut distractions. Remove toxic people. Protect your schedule like your wallet. 2. Stoicism. Minimize emotional errors. Don't chase fads or get-rich-quick schemes. Stay calm in market crashes. Avoid lifestyle inflation. Read Epictetus, Seneca, Marcus Aurelius. Live their principles. 3. Time. Start now, not later. The most valuable asset isn't money, it's time. Wealthy people value time more than anything else. Trade money for time wherever possible. Hire help, automate tasks, say no more. 4. Diversification. Survive, then thrive. Invest in index funds, rental properties, skill sets, businesses. Never go all in on one thing unless it's you. Part 11. The role of luck and how to court it. Galloway acknowledges luck exists, but insists that it favors the prepared. How to attract luck. Like the wealthy, show up consistently. Publish content, attend events, share your work. Be likable. People support those they enjoy being around. Learn fast. The faster you improve, the more opportunities come your way. Help others. Generosity creates positive-sum networks. The harder you work, the luckier you get, but only if you're visible, skilled, and helpful. Part 12. Wealth is a mindset. First, outcome second. Internal shifts precede external results. Scott Galloway ends his philosophy with a challenge. Stop thinking like the broke and start thinking like the wealthy. That shift, he argues, precedes every external result. From victim to owner, from consumer to investor, from passive to proactive, from spender to builder, from reactionary to strategic. When you shift your identity, your behaviors follow, and when your behaviors change, wealth is inevitable. Part 7. Agency, the power of taking control. One of the most understated but vital concepts in Scott Galloway's philosophy of wealth is agency, your power to take control of your life. This isn't about being in charge of everything around you. Agency means refusing to play the victim, even when you have every right to. It's acknowledging the injustice, the pain, the circumstances, but still choosing to act, still choosing to move, still choosing to build. A mindset shift from external to internal control. Many people drift through life operating from a locus of external control, believing that life happens to them. Wealthy thinkers, Galloway suggests, develop an internal locus of control. They believe life happens for them, and more importantly, they believe they can shape their future. You can't control inflation. You can't control market crashes. You can't control office politics, recessions, or who gets promoted. But you can control how many skills you learn. You can control your spending habits. You can control how many hours you invest in building something of value. You can control your health, your boundaries, your social circle. You can even control your story, the one you tell yourself about your past, your worth, and your future. This shift from external blame to internal ownership is the difference between drifting and directing. Decision fatigue and the wealthy mind agency also involves limiting decision fatigue. The wealthy often simplify their daily choices: what to wear, what to eat, what to do first each morning. This isn't laziness. It's strategic conservation of mental energy for higher value decisions. You don't need 20 outfits. You don't need 7 productivity apps. You need systems that work, routines that run, and the freedom to think clearly where it matters most. The wealthy think in terms of leverage. How can I get 10x results with 1x effort? Clear decisions and strong agency allow this, the freedom of saying no. Here's a radical truth. You get wealthy by saying no more than yes. No to distractions, no to gossip, no to fake urgency, no to doing what everyone else is doing. Wealth is accumulated by focus, and focus requires agency. You must direct your energy deliberately and unapologetically. Saying no doesn't mean closing doors. It means choosing your door. Part 8. Execution. Ideas are cheap. Action is wealth. This section may be the most important of all. Scott Galloway does not mince words. Ideas are cheap. Execution is everything. You can have the greatest idea in the world for a business, a book, a product, or a brand. But if you don't execute, it's worth nothing. The wealthy think differently. They don't wait for perfect timing. They don't suffer from analysis paralysis. They act. Then they learn. Then they adjust. Then they act again. Action, perfection. This is where most people fail. They wait until everything is perfect. But wealthy thinkers know perfection is a mirage. It doesn't exist. You start messy. You launch with version 1.0. You put your work into the world knowing it's rough. But then you iterate, improve, learn, grow. Jeff Bezos famously said, "If you double the number of experiments you do per year, you're going to double your inventiveness." Execution isn't about being fearless. It's about being more committed than you are afraid. Grit, repetition, and mastery. The algebra of wealth requires grit, that stubbornness to show up day after day, even when you don't feel like it. Wealthy people don't rely on motivation. They rely on habits and systems. It's about making 50 cold calls instead of 5. It's about writing 10 proposals even if 9 fail. It's about producing 100 videos, knowing the first 20 will probably suck. The wealthy play long games. They build repetition into their strategy because they know mastery doesn't come from reading or watching. It comes from doing. Execution is the daily grind that most people avoid. But it's where the compound interest of wealth begins to show. Part 9. Scale. Don't just work, multiply. This is where the wealthiest minds truly separate themselves from the rest. The average person thinks in terms of addition. How can I earn an extra $1,000 this month? The wealthy think in terms of multiplication. How can I build something once that pays me forever? This is scale, the secret sauce of real wealth. Build once, sell forever. Write a book once, it sells for decades. Create a course once, it scales to thousands. Build software once, it runs 24/7. Buy property once, it appreciates passively. The poor and middle class often trade time for money. The wealthy trade ideas for scale. Ask yourself, can what I'm doing scale beyond my own time and energy? Am I building something that grows while I sleep? If I stop working, does the money stop or does it flow? Wealth is built when you detach earning from hours. Digital leverage. In the modern age, Galloway emphasizes digital leverage as one of the most powerful scaling tools. The internet, code, media. These are levers that multiply impact. If you understand content, tech, or distribution, you can scale yourself to millions of people. This is how creators, coders, and entrepreneurs build global businesses from their laptops. The key is to identify your vehicle of scale. What will allow you to serve 1,000,000 instead of 1? Part 10. The Wealth Equation in Practice. Let's now tie it all together. Scott Galloway presents the Algebra of Wealth as a formula, not a fantasy. It's a set of practices, mindsets, and behaviors that, if consistently applied, result in wealth, not just money, but freedom. Here's the real equation. Wealth, chasse, discipline, plus time, plus ownership, plus execution, plus agency, plus scale. Persistence. Let's break it down. Discipline, spend less than you earn. Delay gratification, avoid debt. Time, start now, let compounding do its work. Ownership, don't just earn, own, get equity. Execution, move fast, build, iterate, ship. Agency, take control, say no, think independently, scale. Multiply your output through media, tech, or business models. Persistence, keep going, outlast, adapt, stay in the game. No secrets, just math. That's why he calls it the Algebra of Wealth. It's not hidden. It's not luck. It's not magic. It's math. It's mindset. It's execution. And most of all, it's possible. Part 8. Discipline, the anchor of wealth accumulation, continued. While people often look for hacks and shortcuts, the Algebra of Wealth argues that long-term financial success requires a consistent application of disciplined effort. This part of the equation separates those who get rich slowly and securely from those who gamble on fleeting opportunities. Galloway insists that discipline is the great equalizer. The 5% rule. One of Scott Galloway's most powerful principles is what he calls the 5% rule. This is the idea that you should live off of 95% of your income and automatically invest the other 5%, no matter your income level. You don't negotiate with this rule. It's non-negotiable, automated, and sacred. Even in times of lower income, the 5% rule is a psychological habit that enforces discipline and prevents lifestyle inflation. Why 5%? Because it's manageable, even for lower income earners, and when applied consistently, it compounds powerfully. For instance, investing just 5% of an average salary over decades creates hundreds of thousands in wealth. Discipline in market timing. Galloway warns against the allure of timing the market. He refers to discretionary discipline as the most dangerous type, the kind where investors believe they are smarter than the market. He shares the truth. Even professional investors fail to beat the market consistently. The real discipline is in staying the course, investing automatically and regularly, regardless of what the market is doing. He urges readers to automate their investing, set it and forget it, and avoid the emotional roller coaster that derails so many well-meaning investors. Discipline in debt management. The wealthy understand the power of leveraging debt, but they also respect its dangers. Galloway lays out clear financial commandments. Never carry high-interest debt. Don't finance things that depreciate, like luxury cars or gadgets. Use debt only when it's tied to appreciating assets, such as real estate or business capital. He adds a provocative insight. Every time you finance something to impress someone else, you've essentially handed your future over to that person. This mindset cultivates frugality, patience, and intelligent use of capital. Hallmarks of wealthy thinking. Part 9. Risk, understanding, and leveraging. To think like the wealthy, you must embrace intelligent risk-taking. Galloway differentiates between reckless risk and asymmetric risk. Asymmetric risk. Asymmetric risk means risking a little to gain a lot. For instance, investing $5,000 into your own side hustle might bring in $50,000 in the future. That's intelligent risk. Wealthy people constantly seek asymmetric opportunities, especially in their careers and business ventures. He encourages readers to view their time as a form of capital that should be invested wisely into projects with high upside and manageable downside. Every hour spent mindlessly scrolling or doing low-impact tasks is risk in the wrong direction. The risk of wasted potential. Career risk versus entrepreneurial risk. Galloway argues that the safest job is often the most volatile in disguise. Sticking with a 9-to-5 job might seem secure, but you're placing your entire income under someone else's control. Layoffs, restructurings, and company failures are risks people often underestimate. Meanwhile, entrepreneurship, while risky up front, gives you multiple income streams and a higher ceiling. It offers ownership, and ownership is the gateway to wealth. That said, he doesn't romanticize it. Galloway believes you must earn the right to take entrepreneurial risks through skill, savings, and preparation. The wealthy don't avoid risk, they manage it. Scott reveals how the wealthy are not risk-averse, they are risk calculators. They insure what needs insuring, they build emergency funds, they diversify their investments, They protect themselves legally. They reduce exposure to catastrophic risk while taking bold steps in high upside areas. Part 10. The Algebra of Wealth in Action. A Life Framework. This section takes all the principles and combines them into a practical life framework anyone can follow. Galloway distills the algebra of wealth into 5 daily and long-term commitments. 1. Automate your savings and investments. From your very first paycheck, automate your 5% 20% savings rule. Invest it into low-fee index funds. Don't touch it. Don't outthink it. Let time and compounding do the work. 2. Build an economic moat around yourself. Learn valuable skills. Update them constantly. Brand yourself on the internet. Build a body of work. The greater your skills and visibility, the more leverage you have. 3. Create multiple income streams. Don't rely on one job. Start a side hustle. Invest in dividend-yielding assets. Launch a digital product. Multiple income streams cushion you from downturns and create exponential wealth. 4. Live below your means. Far below. Every dollar not spent frivolously is a seed of future wealth. The wealthy live like they're poor and invest like they're rich. This mindset ensures sustainability. 5. Play the long game relentlessly. The most overlooked principle is patience. Galloway reiterates that most millionaires didn't make one giant bet. They compounded small bets over time. Wealth is a result of years of correct behavior, not moments of brilliance. Part 11. Wealth versus Riches. The Deeper Meaning. Scott Galloway ends the book on a philosophical note, defining the difference between being rich and being wealthy. Rich people have money. Wealthy people have freedom. Freedom to work on what they want. Freedom to spend time with who they love. Freedom to say no. Freedom to walk away. Freedom to create. He asks readers to redefine their goals. Not just more money, but more agency. Money is just the fuel. What matters is what kind of vehicle you build with it. Final reflections. Scott Galloway's The Algebra of Wealth is not a get-rich-quick formula. It's a get-rich-for-sure philosophy. It emphasizes skills over shortcuts, consistency over speculation, freedom over flashy wealth, discipline over impulse, long-term over now. He teaches us that wealth is built like a cathedral, brick by brick with intention and time. Every small habit, every wise investment, every hour of skill building is a brick in that structure. In the end, it's not about thinking like the wealthy. It's about thinking differently, with clarity, discipline, and purpose.